What if the story you're hearing everywhere is wrong? In 2025, gold had a monster year. While Bitcoin stagnated, gold hit new highs, and the mainstream narrative was set. Digital gold had failed. When uncertainty hits, investors run back to what's familiar. But that story is missing the bigger picture. The script is about to flip, and 2026 is the reason why. The very forces that crowned gold are now setting the stage for Bitcoin's comeback. Let's be honest about where we are. Gold's dominance in 2025 wasn't an accident. It was the logical outcome of a world gripped by caution. 2025 was defined by nervousness, macroeconomic uncertainty, geopolitical tension, and a cooling labor market. In that risk-off environment, capital did what it's always done. It ran for safety. And for most of history, safety has meant gold. Investors weren't betting against Bitcoin's future. They were prioritizing immediate stability over long-term growth. We saw a clear rotation away from volatile assets and into traditional stores of value. Gold's performance was a direct reflection of a market de-risking. The narrative was simple. In trouble, you own the proven thing. Gold played its part perfectly. But here's the core argument. Gold's outperformance wasn't a verdict on Bitcoin. It was a precursor. This isn't one asset winning and another dying. It's a story of a predictable rotation of capital, driven by macro triggers set to fire in 2026. We are on the precipice of a huge shift in monetary policy. After delivering rate cuts in 2025 to fight a cooling economy, the Federal Reserve is expected to continue easing policy in 2026. This shift from a tight to an easing environment is the primary catalyst. It signals that maximum fear is passing and it's time to look for growth again. This is the setup for the Great Rotation, a massive shift of capital away from the crowded safety of gold and into the high-potential growth of Bitcoin. We're about to see investors decide they no longer need gold's insurance policy. They're getting ready to buy a lottery ticket on the future. So, what are these triggers? It comes down to three forces: monetary policy, national debt, and global liquidity. First, the Fed. After cutting rates in late 2025, Wall Street now prices in more cuts for 2026. Major firms like Goldman Sachs and JP Morgan forecast the same. Lower interest rates are rocket fuel for assets like Bitcoin because they make holding cash less attractive and inject more money into the system. Think of capital as water, seeking the highest return. When rates were high, the water pooled in gold. As rates fall, the floodgates open towards assets with higher growth potential. Second, the U.S. national debt. As of early 2026, it has blown past a staggering $38.43 trillion, growing by over $2.25 trillion in the last year alone. Annual interest payments are now approaching $1 trillion. This is a direct threat to the long-term value of the U.S. dollar. In a world of relentless money printing, the case for a non-sovereign, scarce asset becomes undeniable. While both gold and Bitcoin serve this purpose, Bitcoin's absolute scarcity of 21 million coins presents a harder alternative to a fiat system in overdrive. These factors create the third trigger, the return of liquidity. The environment of falling rates and a weakening dollar that initially favors gold eventually propels capital out of it towards assets with more upside. The market is shifting from protecting capital to growing it. All signs suggest 2026 is the year the tide turns. Before we get to the final piece of the puzzle, the institutional signals pointing to this rotation, if this breakdown is opening your mind to a new set of possibilities, do yourself a favor and smash that subscribe button. We break down this new world every week, and I want you in this community. The macro environment is only half the story. The market structure has fundamentally changed, creating pathways for capital into Bitcoin that never existed before. The story of 2026 is institutional adoption, moving from theory to reality. For years, we heard the institutions were coming. In 2026, they are here. The launch of spot Bitcoin ETFs from giants like BlackRock and Fidelity was the appetizer. Now, we see legacy firms like Morgan Stanley filing for their own spot Bitcoin products. This isn't retail speculation. This is the world's most conservative capital building, long-term strategic positions. This shift is creating entirely new structural demand for Bitcoin. The conversation is even evolving towards nations adding Bitcoin to their strategic reserves. While few have made formal moves, the discussion itself elevates Bitcoin from a retail asset to an institutional and even sovereign-grade one. We can see this tension in the Bitcoin to gold ratio chart, which shows how much gold it takes to buy one Bitcoin. After falling for much of 2025, many analysts now see this ratio at a cyclical bottom, poised for a powerful reversal in Bitcoin's favor. Just as the ratio's fall signaled a flight to gold, its recovery could signal the start of the Great Rotation back into Bitcoin. This brings us to the final point: why this rotation will be so powerful. Bitcoin isn't just a better version of gold, it's a superior asset for the digital age. Gold is an analog asset in a digital world. Its scarcity is physical. Its transfer requires vaults and guards. It's hard to verify and impossible to send across the world with a click. Bitcoin is the opposite. Its scarcity is digital and absolute, enforced by code no government can control. It's borderless, letting you send millions in value across the globe in minutes, without permission. It's censorship-resistant, providing a financial lifeline to those in geopolitical crises or under oppressive regimes. As our world becomes more digital, it's logical that our primary store of value will become digital too. Gold represents the past. Bitcoin represents the future, a store of value for a global, interconnected world. Institutions aren't just buying an inflation hedge, they're buying a piece of new financial technology. They are buying programmatic scarcity fit for the 21st century. Gold is a defensive asset. Bitcoin is both a defensive and a technological asset. In a world being rebooted by lower rates and fresh liquidity, that technological upside will attract a tidal wave of capital. So, let's bring it all together. 2025 was the year of gold, crowned by fear and uncertainty. But the very forces that put gold on the throne, a slowing economy and the anticipation of policy change, are now setting the stage for its successor. The Federal Reserve rate cuts expected to continue in 2026 are creating a macro environment tailor-made for a risk-on rotation. The institutional floodgates are now open, with regulated products from the biggest names on Wall Street. While gold was the asset for protecting wealth in a crisis, Bitcoin is emerging as the asset for building and protecting wealth in an era of digital finance and currency debasement. The story of 2025 was risk-off. The story of 2026 is shaping up to be the Great Rotation. This isn't the end of gold. It's the dawn of a new, digitally native store of value ready to take its place.